For over 5 decades, Japan has been the silent pillar holding up American financial power. While everyone focuses on China, Japan quietly holds $1.18 trillion in U.S. Treasury securities, making them the largest foreign creditor to America. That's more than China, more than the UK, more than any nation on Earth. But what makes Japan truly dangerous isn't just the debt they hold. For decades, Japanese investors have been borrowing yen at near-zero interest rates and flooding that cheap money into American stocks, bonds, and real estate. This is the yen carry trade, and its size is staggering. Conservative estimates put it at hundreds of billions of dollars, with broader yen-funded exposure potentially reaching the low trillions. Think about what this means. Trillions of dollars propping up American asset prices, all funded by borrowing in a currency that's been essentially free for 20 years. This arrangement has been the invisible engine of American prosperity, keeping our interest rates low, our stock market elevated, and allowing us to run massive deficits without consequence. But on December 1st, 2025, everything changed. Bank of Japan Governor Kazuo Ueda stood before business leaders in Nagoya and announced the central bank would consider raising policy interest rates at their December meeting. Within hours, markets convulsed. The probability of a rate hike jumped from 58% to 76% overnight. Japanese government bond yields surged to their highest level since 2008. Global investors began to panic. Why? Because after maintaining negative interest rates for nearly a decade, Japan is finally tightening monetary policy. And when Japan tightens, the entire global financial system feels it. Bank of Japan officials are ready to raise interest rates at their policy meeting later this month, likely moving from 0.5% to 0.75%. But that's just the beginning. Analysts are forecasting the terminal rate could reach 1.5% by the end of 2027, with additional hikes coming throughout 2026 and 2027. This might not sound like much, but in a world where Japan has had zero or negative rates for over 20 years, even small moves create massive ripples. Here's where it gets truly dangerous. For years, the yen carry trade was the easiest money in finance. Borrow yen at 0%. Invest in US assets yielding 5%, 10%, even more. It was a money printer. But now, as Japanese rates rise and the yen strengthens, the trade is reversing. And it's not reversing slowly. It's unwinding with the force of a tsunami. When the carry trade unwinds, investors must sell their US stocks and bonds, convert those dollars back into yen, and repay their loans. This creates massive selling pressure on American assets and on the dollar itself. We've seen this before. In August 2024, when the Bank of Japan made a surprise rate hike, the Nikkei fell 12.4% in one day, and the S&P 500 subsequently dropped 3%. Its worst one-day loss in nearly 2 years. On December 1st, 2025, when the yen jumped after the BOJ's rate hike signal, Bitcoin slid from $92,000 to $83,832 low, a move directly linked to carry trade unwinding. And that was from just one rate increase. Now multiply that by several rate hikes over the next 2 years. The potential for chaos is enormous. But the carry trade is only part of the story. While it unwinds, something else is happening that should terrify every American. Japan has been quietly selling US Treasury bonds. In the third quarter of 2024, Japanese investors sold a record-breaking $61.9 billion in US Treasury securities, the largest quarterly sell-off ever recorded from Japan. The selling didn't stop there. From the start of 2025 through April, Japanese investors dumped approximately $227 billion worth of US government bonds. Now, Treasury officials will tell you this is no big deal, that the Treasury market is enormous. But they're missing the point. It's not just about the numbers. It's about momentum. It's about psychology. When the world's largest holder of your debt starts selling aggressively, other investors notice. They start asking questions. They start demanding higher yields. And that's exactly what happened. After Trump announced aggressive tariff policies in April 2025, yields on 10-year US Treasury bonds spiked to 4.592%, marking the largest weekly increase since 2001. The panic spilled over into stocks, causing the S&P 500 to plunge 12% in just 4 trading days. According to analysts, most of the selling came from Japan. But why is Japan doing this? Why would they destabilize their closest ally? The answer is simple. They have no choice. For years, Japan has been trapped. Their economy has stagnated. Their population is aging and shrinking. They tried everything. Negative interest rates, unlimited quantitative easing, direct market interventions. Nothing worked. Meanwhile, their currency was crushed. The yen hit 161 to the dollar, the weakest level since 1986. This devastated Japanese purchasing power, making imports ruinously expensive and fueling inflation the country hadn't seen in decades. Here's the cruel irony. The very thing keeping the yen weak was Japan's financial support of America. As long as they kept buying our debt and keeping their rates at zero, the yen would stay weak and their economy would suffer. So now they face an impossible choice. Continue sacrificing their economy to support the dollar, or pull back and risk destabilizing the global financial system. They've chosen their own survival, and that means America is on its own. But it's not just Japan. 3 massive forces are converging simultaneously, all threatening the dollar. First, the Bank of Japan's rate hikes are unwinding trillions in yen-funded positions across global markets. Second, Japan is pulling back from Treasury purchases and actively selling, just as US deficits explode to $2 trillion annually. Third, the broader de-dollarization movement is gaining unstoppable momentum. According to Wellington management analysts, this foreign ownership constraint means the Fed cannot ease as much as markets are currently pricing, even if growth decelerates. The Federal Reserve is caught in an impossible trap. If they cut rates to support the economy, the dollar weakens and foreign investors dump US assets. But if they keep rates high to defend the dollar, they risk crushing the American economy with expensive mortgages, car loans, and business borrowing. And remember, this is happening while the US government runs $2 trillion deficits. We need foreign buyers to finance these deficits. But they're not buying anymore. They're selling. This brings us to December 19, 2025, less than 2 weeks away. If the Bank of Japan raises rates as expected, several things will happen simultaneously. The interest rate differential between US and Japanese bonds will narrow, making the carry trade even less attractive. The yen will likely strengthen significantly, forcing more liquidation of dollar positions. Japanese government bond yields will surge, creating competitive pressure on US Treasury yields. And the repatriation of capital back to Japan will accelerate, as domestic yields become attractive for the first time in decades. Think about the 3 pillars that have supported dollar hegemony for the past 50 years. The petrodollar system, where oil is priced in dollars. This pillar is weakening as major exporters diversify. The willingness of allies like Japan to finance US deficits by holding massive treasury positions. This pillar is cracking as Japan prioritizes its own survival. and the yen carry trade and other forms of foreign capital flooding into US markets. This pillar is actively unwinding right now. When all three pillars weaken simultaneously, which is exactly what's happening, the entire structure becomes unstable. So what should you expect? In the near term, watch for extreme volatility. The December 19th Bank of Japan decision will be critical, but the real danger isn't the next few weeks. It's the next few years. As Japan continues normalizing monetary policy and the carry trade continues unwinding, the US will face persistent downward pressure on asset prices and upward pressure on borrowing costs. This will make it harder to finance our deficits and maintain our standard of living. And here's what keeps me up at night. Once this process starts, it's very hard to stop. Foreign capital flows are like water. Once the dam breaks, the flood is inevitable. And right now, we're watching the cracks spread through that dam in real time. The American economic empire was built on three things: the petrodollar, treasury demand from allies, and yen carry trade liquidity. One by one, these supports are being pulled away. This is why you won't see this story dominating mainstream financial news. Because once people understand what's really happening, once they understand that the foundation of American prosperity is eroding in real time, panic becomes inevitable. And panic is exactly what the system cannot afford right now. But you need to understand this isn't about doom and gloom. This is about understanding the real risks you face, so you can prepare accordingly. The dollar won't disappear overnight. American power won't evaporate in a day. But the world is changing, and the assumptions that have held for 50 years are no longer valid. Japan just fired the opening salvo in what could be the greatest challenge to dollar hegemony in modern history. And on December 19th, we'll find out if this is just a warning shot or the beginning of the end. The dollar's biggest test has begun. And this time, there's no bailout coming from Tokyo. Stay vigilant, stay informed. And whatever you do, don't believe the lies they're telling you about how everything is under control. Because if everything was under control, Japan wouldn't be making these moves. And the Bank of Japan wouldn't be preparing to pull the trigger on December 19th. The countdown has begun.